This is still a period where it's going to be very difficult for the Fed to sound anything other than hawkish.
Powell might have to thread the needle and talk the market away from the ledge, if you will.
What they don't want to do is intentionally cause a recession, and getting to that point, I think, will require a bit of luck.
Despite that recession risk in the horizon, this is an emboldened Fed that wants to continue.
This inflation situation is so extreme, you just have to hike. There's no way around it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good to be back, Bramo. Good to be back. Live from New York City. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Futures down 0.9% on the S&P. Lisa, another morning of losses coming right up.
And it comes ahead of a meeting not only from the Federal Reserve, but more than a dozen other central banks within a 24-period time, where they're expected to raise rates by 500 basis points on a combined level. This is a global tightening cycle, and people are trying to price in what that means for economic growth.
Equities down, yields up. Your 2-year advancing, I think, for an 8th consecutive session. Your 10-year through 350. We'll keep reflecting on this through the morning. But Lisa, how many guests came on in the last couple of months and said the high of the year was the June high? Well, now we've got a September high.
Right.
That's a new high of the year.
So this raises a question. How quickly do buyers come back in, or is there a reset of how high inflation will allow it to stay, because central banks do not want to experience the pain required to get inflation back down to that 2% target? Expect a lot more discussions about this, and expect a lot of questions about what exactly 4 to 4.5% Fed funds rates really means for the economy.
So we've both read a lot of notes coming into this week ahead of the Federal Reserve. I've found maybe a glimmer of hope over at Wells Fargo with Chris Harvey. Chris said this: the anticipated decelerating path to terminal by the market and ourselves is, in our view, expected to be a near-term positive for risk assets, including stocks. How many people share that view, Lisa? And will we actually get that decelerating approach to terminal? Because at the moment it's 75 and maybe 75 again in November.
So if you take a look at where Fed funds futures trading prices have really put things, there is a deceleration and then a pivot, if you will, next year. Perhaps not as aggressively as people had thought. What's not understood, and to me this is what I'm really thinking a lot about, John, it's not understood what kind of economic pain a 4 to 4.5% Fed funds rate, even briefly, will incur. And that really is the question. If it does incur a lot of pain, then what does that mean in terms of what you can expect with equity valuations?
It's a simple question for Wednesday. Will the forecast from this Federal Reserve capture some of that pain? Will it capture the risk of hard landing?
If it doesn't, what does that say about Fed credibility?
What does it say about a forecast? How many guests have we had call them aspirational over the last several months?
Fantasyland, aspirational.
All of the above. I can't wait to do it again on Wednesday.
Exactly.
We'll get ahead to Wednesday. Former Vice Chair Rich Clarida alongside us, going out of the decision and coming out of the news conference too. I think we're all looking forward to that. Futures right now, they're down 0.9% on the S&P. On the Nasdaq 100, negative 1 full percentage point. Yields higher by 4 or 5 basis points on a 10-year and briefly through 350, 349.83. Euro dollar negative here, Lisa. We're down 1/3%, 99.87.
It's very much dollar strength, and a big question for this week is how concerned is the rest of the world about that dollar strength, which is leading to importing inflation even more so. Here's what we're watching in the week ahead. Today, we have more of the pageantry coming out of the United Kingdom, and we have some housing data. This week, though, is a massive week. The United Nations General Assembly meeting happens in New York City. President Biden will go from London to Washington, D.C., and then to New York City on Tuesday with a host of other world leaders. Expect a lot of gridlock, but also expect a big discussion about this new world order that we keep talking about with China and Russia and the Western states. Also, on Wednesday, this really is the main issue. Fed rate decision, also rate decisions for more than a dozen other banks in just 24 hours. This is something I am not understanding. What is the joint effect of all of this hiking, right? I mean, we're talking about the global easing cycle. How do you put that into reverse when people are still talking about excess liquidity? And then at 12 p.m., on Thursday, Janet Yellen, Treasury Secretary, is going to be making some testimony. Some people are concerned about what she's going to say about the IRS. Also, digital dollar, that is a big topic of discussion. I'm curious to hear what she has to say about inflation, though, especially given some of her mea culpas about transitory in the past.
And the focus stays on the UK as well, Lisa, in a very different way, because it's back to reality for the Conservative Prime Minister, Liz Truss. I believe we get a mini budget, we get a Bank of England rate decision, and we're staring down the barrel of 113, maybe 112 on sterling, 113.79 right now.
That's what I was going to say, is take a look at the FX market. It's already weighing in on that plan, and it was supposed to be a quiet week. It was not in the FX market for Great Britain. And how much does she sort of create even more weakness when she starts to propose the details of this plan?
Mike McKee joins us here in New York. Mike McKee, great to catch up with you, sir. Let's start with the Fed. 75 or 100. Mike, how unusual would it be to follow up with 100 basis points at this meeting, given they haven't flagged or signaled that?
Well, it'd be virtually unprecedented. I mean, you have to go back to the Volcker years when they were not targeting a particular rate, but the money supply to see the effect of a 100 basis point rate cut or more. I mean, they have gone as much as 400 at one meeting during the Volcker years, but we're nowhere near that now. So I think if you got 100, it would shock a lot of people in the markets, and there would be a knee-jerk market reaction that the Fed doesn't want to risk. Also, long and variable lags. They don't know when the full effect of a rate increase is going to hit the economy, and so they'd rather be a little more cautious than 100. Not that 75 is a mild rate increase by any means.
Mike, how much discussion is there in your Federal Reserve circles about the disproportionate effect of rate hikes on lower income individuals at a time when they used to have a dual mandate, when they used to be more concerned about the varying and broad effects? And now it seems like they have one mandate, and that is to get inflation down at the expense of anything else. Is that really what the discussions are like behind the scenes?
Well, essentially, I mean, they've been concerned in recent years more publicly with people in the lower income strata, but they also feel that inflation is a big tax on those people, much more so than wealthy people who have big bank accounts. And so getting inflation down is a good move for people in the lower income strata. Now, there will be some job losses, but they think that the job losses can be contained because there are a lot of openings right now. So their focus is going to stay on inflation.
Mike McKee, thank you. Mike McKee covering all these central bank decisions this week, and there are many. Lisa went through some of them. 350 on a 10-year, briefly. Right now, 349, yields up 4 basis points. On a 2-year, up 5 basis points, 392. Joining us now, David Stubbs, Global Head of Cross-Asset Thematic Strategy at JP Morgan Private Bank. David, good to catch up with you, sir. Let's start here. Can you give me one good reason to be bullish right now?
Well, John, I think if you're going to make the bullish case, I think you're going to look at the resilience of domestic consumer spending in parts of the Western world. I think you're also going to look at how much tightening has been priced in, and indeed expectations of recession broadening across Wall Street. But I think bullish is not that we're going to see the kind of boom conditions we saw last year. Bullish would be a soft landing, a pretty soggy economy next year, but one that avoids a recession and avoids a major drawdown in earnings. That's as bullish as you can get, I think, right now.
That's not exactly a ringing endorsement of risk assets, David. I do wonder, especially at a time when Tina is dead, right? There is an alternative, and it is cash. It is short-term instruments that are actually yielding something on inflation-adjusted terms for the first time in a long time. Is there any justification not to just hide out in some of these instruments, collect the income, and wait for a better, more clear entry?
Well, we're absolutely recommending parts of the fixed income universe. At this point, as you rightly say, a lot of value has been created both at the short and long end. As you were saying in the intro, the 10-year at 350, we would be buyers of that in portfolios that don't have any duration right now. We see a lot of value in preferreds as well. So there's plenty of ways to meet your financial goals if you want a mid-single-digit return without taking a lot of equity risk. And it's maybe the first time you could say that in a long time, given the lower for longer era that we've been through on interest rates.
David,
but also, Lisa, I think that you've really seen still some value be created in the structural changes that we see in the economy going forward. Clean energy, fintech, genetic therapy, some tremendous value there in factors and themes that are going to be huge drivers of our society going forward.
David, I just want you to elaborate a little bit. You said that you would be buyers of 10-year treasuries at 3.5%. Do you think that this is the new peak and that basically they cannot continue to lose more value, yields up further?
Oh, no, we'd never say that definitively. But we just think that parts of the fixed income space right now have some asymmetry about them. If we do go into a recession next year, we would expect bond yields to fall significantly. And we think that the potential returns in that scenario are now greater than the losses that you may get if bond yields continue to drift higher. So, look, there's absolutely not a risk-free trade right now, but a lot of our clients' portfolios have very, very short to nil duration, and clients have been waiting to leg in to better yields over the medium to longer term. Well, now here they are, and I think for the right portfolio, for clients looking for that yield and for that stable return, Treasuries now are an option in a way, as you said, that they had not been in the previous decade.
Hey, Dave, thank you. David Stubbs there of JP Morgan Private Bank. Lisa, that positive correlation between equities and bonds right now is pretty toxic. Your 2-year at 390. Never mind buying 10s. Front end of the curve now, almost 4%. Isn't that a story?
Yeah, and how much more can you actually see yields continue to rise in the front end if you have 4 to 4.5% Fed funds rate almost baked into expectations right now if you take a look at some of the futures trading? So what does that mean for the curve inversion, right? Does that basically just mean that it widens to a record level because people do keep piling into 10-year treasuries? Because longer term, this confers some sort of pain that will be expressed in lower inflation, lower growth over the next 10 years.
How do you think this Fed's going to tee up the November decision? Evercore's Julian Emanuel wrote about this over the weekend, flagged the midterms that take place several days after that decision. Do you think that's something they have to take into account? Because typically, in a rate hiking cycle around the midterms, Lisa, we'd be having a conversation about maybe this Fed sitting that out. That's not the conversation this time around.
Do you think that if they actually did care about the midterm elections, that anyone would say it who is anywhere remotely connected to the Federal Reserve? They are going to stay away from that as hard as they can because that is toxic. They are not politically motivated.
Mike McKee's going to ask him about it in the news.
Good, I hope so. He always asks
I made
the
that
hard
up.
questions.
I've got no idea if Mike McKee's going to ask him about it.
Trying to direct him.
Maybe he should, but he won't answer it. Anyway, as you pointed out, I'm not sure he ever answers a Mike McKee question.
Correct, which is why he goes last.
Futures down 0.8% on the S&P. On the Nasdaq 100, down almost 1 full percentage point. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Leaders from around the world gathered in London today for the funeral of Queen Elizabeth II. More than 2,000 people attended the ceremony in Westminster Abbey for the UK's longest-serving monarch. Over the last 4 days, hundreds of thousands of people lined up for hours to pay their final respects. President Biden says U.S. forces would defend Taiwan if there was what he called an unprecedented attack. It was the administration's latest pledge of support as it seeks to deter China from increasing military pressure on Taiwan. And the president was interviewed for the CBS News program 60 Minutes. Ukraine's President Volodymyr Zelensky has renewed his pledge to retake all Russian-controlled territory after his country's recent advances. Zelensky hinted that another offensive is being planned. Ukraine claims that some Russian military units suffered loss rates of up to 90% in their retreat. In Hong Kong, local media report the city may end hotel quarantine and pre-flight COVID test requirements for incoming travelers. That would be its most significant moves yet to end more than 2 years of global isolation. The changes may come before a series of major international events set for Hong Kong starting in late October. Volkswagen wants to raise up to $9.4 billion from the IPO of iconic sports car maker Porsche. It would be Europe's largest listing in more than a decade. VW is seeking a valuation of as much as $75 billion. That's below an earlier top-end goal of as much as $85 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We've got a substantial underlying inflation problem that doesn't come out without very substantial monetary policy adjustment, and the market is waking up to that fact and is now building in substantially more monetary policy adjustment.
Is it enough or too much? That was Larry Summers, the former Treasury Secretary on Wall Street Week with David Weston over the weekend. Live from New York City this morning. Good morning with Lisa Abramowicz. I'm Jonathan Ferro. Futures down 0.8% on the S&P. Andrew Hollenhorst over at Citi. Publishing just moments ago, Lisa, here's the quote for you. The Fed will need to confront whether the 4 to 4.5% terminal rate now being priced in is restrictive or just neutral, given underlying inflation currently at 4% plus.
It's a moving target in a moving economy, and how can they really signal that at a time when they want to keep financial conditions tightening further, right? We're not going to get much clarity on them, basically, on this front, because they're going to have a hawkish tone. Otherwise, the market will move against them.
Well, financial conditions are tightening right now. We're down 0.9% on the S&P. Yields are higher. The dollar's stronger. Let's throw that question at Nick Benenbrook, the international economist at Wells Fargo. And Nick, let's start there. Is 4 to 4.5%, the terminal rate being priced by this market right now, restrictive or just neutral?
Well, I would imagine it's probably neutral. Maybe it's slightly on the restrictive side. But certainly in the current context, when you've got core inflation at 6.3%, when you've got headline inflation at 8.1%, I mean, our forecast at Wells Fargo is we're going to peak at 4 to 4.25%. But I do believe, we see risks to the upside to that. So it could be that the neutral rate is a little higher than that 4 to 4.5% region.
Well, clearly they want growth below potential. They want it to be restrictive, and they want to bring inflation back down. Nick, how much below potential do we need growth to be to get inflation back towards target, back towards 2%?
Well, that's a very good question. I think, 2% potential growth, trying to sort of engineer the soft landing, I think is a very delicate dance. And maybe even a little bit unreasonable in terms of expectations of financial market participants. It's like kind of almost landing an aircraft just on a picnic blanket, shall we say. So yes, while you can perhaps aim for growth of say 0.5 to 1%, that's a very precise kind of just the fact that you can bring the economy to that slow level, but not then tip it into recession. So, I do think we need to get into that 0 to 1% range, but it's going to be extremely difficult to just be so precise with your machinations in terms of interest rate policy.
And there's a question about the collateral damage, Nick, especially as the dollar strengthens, as John was mentioning. In some levels, the strongest going back to 2002. The World Bank has been warning that we will enter some sort of global recession if the Fed continues to tighten at the pace that they're projecting. Do you agree?
We do agree in the sense of we have a recession for the United States. We think it's more likely than not. And then actually, when you look at the Eurozone and the United Kingdom, it looks like perhaps there's an even clearer path to recession there. We believe those start in late this year because of those energy price increases. So, I wouldn't want to criticize central banks or policymakers or what they're doing. It's unfortunately just the world we live in and the reality. It's a very significant inflation problem, and it's going to be hard to get that longer-term inflation under control without a significant disruption to near-term growth.
How much is this being driven, particularly the pain in non-U.S. countries, by the strength of the dollar? How much is that creating a feedback loop of having to import inflation even more and really frustrating central banks and fiscal policymakers?
Yeah, I think that's a relevant point. I think the strong dollar in the case of the US, it's probably not a particular problem. In fact, it's probably helpful given the inflation that they have. But we have started to see some central banks, the Bank of Japan is perhaps a very obvious example. They're very concerned at the weakness of the yen. I think even the European Central Bank, with some of its comments, have started to at least notice the weakness of the euro. So the strong dollar, I don't think, is a problem or an issue for the Federal Reserve, United States policymakers, but it is becoming at least bothersome, I would say, for many foreign central banks. However, at the end of the day, it's those domestic inflationary pressures, even in places like the Eurozone and the United Kingdom, that are front and center and are probably the main issue.
Nick, words are failing on the FX front, though. The Bank of Japan has tried some verbal intervention. It hasn't worked out. China's trying to do the same with the way it fixes the currency on any given day. That's not working out. Nick, do you expect a policy response from some of these central banks that are grappling with a weaker currency that at this point is undesirable?
Yeah, I would say the answer to that is probably not. Certainly not a policy response in terms of foreign exchange intervention from the Bank of Japan, for example. And, if you go back 2 or 3 decades, even the Bank of Japan in the 1990s and the early 2000s, when it was a very heavy and active player in the foreign exchange intervention markets, those interventions were at best modestly successful. And of course, the foreign exchange markets nowadays are much more liquid. So I suspect that most central banks, if not all central banks, will really refrain from any large-scale FX intervention. I do not see that as part of the landscape.
What do you expect to hear from the Bank of Japan this week?
I think when you look at the Bank of Japan, I really wouldn't expect much of a change in message. In fact, the typical pattern this year has been a lot of speculation heading into these meetings that they will allow bond yields and interest rates to rise, and that they will have to give way on the cap that they have on Japanese government bond yields. But the Bank of Japan has been especially comfortable with the idea that they've got modest growth, and they certainly don't. One of the few countries that has limited inflation. It's only about 2.5%. So from an economic perspective, I think they're happy with current policy settings. And for that reason, I think they will continue to say, we will buy bonds as needed. We will keep these bond yields low. I don't see any change in message from the Bank of Japan.
Hard to imagine the Fed's going to have any sympathy for them. Nick Bannonbrook of Wells Fargo, thank you, because at the end of the day, if they're complaining about it, Lisa, they can do something about it, can't they?
Just remove the yield curve control, and all of a sudden they get a currency that reflects more of the normalcy that is the differentials in economy. I just question how comfortable it really is. I mean, we were talking, and we were talking about this last week when we were in London, about how the grocery store prices reset at the end of this month. We were talking about this with Jeffrey Yu. And all of a sudden, there will be sticker shock, where people will actually start to experience the imported inflation of such a weak yen relative to the dollar. Is that comfortable?
I remember a message I received in the last couple of weeks on this. I just wonder how comfortable the bond market would be with the removal of yield curve control on a morning where we have twos at 392, and maybe this is more pertinent to the long end of the curve on a 10-year in America of close to 350 and through 350 a little bit earlier this morning.
It's a great point. People saying that one of the tail risks for the 10-year yield, what could make yields go much higher, even hit a 5% level, would be the Bank of Japan abandoning their yield curve control. That would roil markets in a way that people are not expecting. The currency perhaps is expecting some sort of change, policy disruption, but not necessarily the JGB market that is no longer a market, and markets that have basically discounted the yield curve control being abandoned.
Hasn't been a market for a long, long time. Yeah. How many people have you spoken to that said 350 is a buy on a 10-year? Here it is, 349.
And David Stubbs basically reiterated that, saying this is a good time to go long, because if you haven't really been long, if you've had short duration, you're actually getting yields. Okay, but what happens, right? I guess that this is the question, the balance of risks. People seeing it less likely that the Bank of Japan will abandon the yield curve control. Then we get some sort of downturn in the economy that sends people back into longer-term treasuries.
We'll talk about the opportunity in fixed income in just a moment. Matt Brill, the head of North American Investment Grade and Invesco, is going to join us in about 5 minutes' time. If you're just tuning in, futures are lower, down 0.9% on the S&P. On the Nasdaq 100, we're down about 1%. Yields are higher, briefly, on a 10-year. Through 350, just short of that right now. On a 2-year, 392 and pushing 393. From New York, this is Bloomberg.
We are into the thick of what we think is going to be a disappointing earnings revision lower.
To get inflationary pressures under control, you just have to expect earnings across the board to be lower than they are now.
One of the issues that we're basically facing is an economy at its capacity constraints.
The strength of the dollar is already pushing half the world economy under the bus.
Price stability matters more than the risk of unemployment at this point.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a week for central banks coming right up. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Futures are down about 1% on the S&P 500. Lisa, yields are higher, much, much higher.
Yeah, reaching the highest level since what? You were talking about this before. 10-year yields reaching the highest since 2011. That 2-year yield continuing to climb. This expectation that central banks are poised to hike aggressively. And that, yes, that will curtail longer-term growth, but will it be enough to get back down to that 2% target?
Up close to 7 basis points on a 2-year now. 393 on a 2-year. I think that's 8 consecutive days of a 2-year yield climbing. Have we seen the bulk of this rate shock off the back of that inflation print a week ago?
Right now, the market is pricing in more than a 4% Fed funds rate by the end of this year. I keep repeating this, but what's not known is what kind of pain that will cause on the economy and how resilient this economy will be. Is this a liability that it is less interest rate sensitive right now, with people having locked in mortgage rates at very low rates? The idea that people don't have as much consumer debt, the idea that companies are flush with cash, this all makes the economy more resilient, which makes the transmission mechanism delayed, making it hard to see the pain when it comes.
So will inflation keep surprising to the upside? In addition to that, Bank of America said this: in the last 18 months, headline inflation has surprised to the upside 11 times and to the downside only twice. This week wasn't meant to be like this, Lisa. We were meant to have another soft inflation print. We'd talk about that step down, that shift lower in rate hikes from 75 to 50, the next one 25 and the pause. That was kind of the soft landing hope. that got some freezing cold water poured all over it in the last week.
Especially because of what elements really were driving the inflation. Not only was it rents, which actually affects the lower income individuals, but the higher income individuals keep getting wage increases that are driving some of the inflation. I was looking at the Atlanta wage tracker, the Atlanta Fed wage tracker. It now has a 6.7% average gain in wages, which is below the headline inflation number, but still the highest rate going back to 1983. How do policymakers message that this is a bad thing, that they want people to lose their jobs and get smaller wage increases at a time when these people have been arguing for a bigger share of corporate gains for so long?
That's why I think it's going to be very difficult for this government to keep on giving the Fed the space that it's giving it at the moment. It's all well and good. I saw some comments from Jared Bernstein, an advisor to the White House, on the economy over the weekend, talking about the prospect of the Fed doing its job, getting inflation lower. House prices will naturally come down because of that. To your point, when we start to see the job losses, is everyone going to be on the same page that we need to keep on hiking?
And when you talk about everyone, it's not just in the United States. I mean, this has been the week of the UN General Assembly in New York City. Global leaders are going to get together. They are dealing with the same inflationary pressures. They're dealing with the post-pandemic realities, but a very different landscape based on the dollar, based on the fact that the U.S. has a much stronger wage growth and employment picture than a lot of other countries. How much pressure is there internationally at a time when really it's become very difficult in many places?
Massive pressure, including on Europe. We've just come back from the UK. We should reflect on that. Tom Keene and the team doing a great job wrapping up the funeral service for the late Queen earlier this morning. For the Prime Minister, Liz Truss, it's confronting reality almost immediately through the rest of this week.
Do you think she's confronting reality? Do you think that that's an accurate description of what her policy is putting out there?
They have to confront the reality of the policy they've put out there. It's very, very expensive. We don't know how much it's going to cost. We just know it's very, very expensive, and there are some doubts in this market already.
Well, that's what I was going to say. The reality of a pound below 114. All of a sudden, they're looking at the pound weaker than that 1992 Black Wednesday that we were talking about, the anniversary of which was last week, going back to 1986, I believe.
Bank of England rate decision on Thursday, too. 1985, the weakest since,
1985.
I believe. Yeah.
Thank you. I appreciate that.
I remember that. Well, I don't at all. Futures.
I was about to say, what are you talking about?
Keene. It was 1922. I remember it so well. He doesn't either. We're down 0.9% on the S&P. He might. On the Nasdaq 100, we're down 1 percentage point. We've talked a lot about the move in yields. We're up 5 basis points on a 10-year 350. Do we have to get comfortable with 350 now? I'm still not comfortable with 394 on a 2-year. It was only a week or so ago we were talking about 360, 370, 380, now 390, and staring down the barrel of 4 percentage points. So, Lisa, reflecting on it all, both nominal and real rates are above the June highs, and the equity market's still about 5% off the June lows. Is a retest now inevitable?
I mean, some people say yes, right? Certainly the Mike Wilson crew over at Morgan Stanley and other people are saying the fact that companies have held in this well, the fact that consumers keep spending, the fact that CPI continues to increase and you're seeing or not decelerate as quickly shows the strength, not necessarily the pain that will need to happen later on.
Matt Brill joins us now, the head of US Investment Grade and Senior Portfolio Manager at Invesco. Matt, have we seen the worst of it, and do you want to start buying?
Hey, good morning, Jonathan. I think we've probably not seen the worst of it yet, but things are certainly attractive. I think if you look at valuations, it's impossible to argue that things don't look cheap, particularly in investment grade and high yield. They look very cheap, but the problem is investors keep being early, and it's painful to be early. You know, the old saying is, if you're early, you're wrong. And right now, everybody that's been early has been wrong. And so even though the valuations are there, it looks attractive. You're probably going to make money over the next year, but over the next few weeks, who knows? We still got to get to the next CPI print before you can have any sort of clarity at this point.
Although, Matt, a lot of people question what credit spreads, what the extra premium that investors demand to own corporate debt over benchmark rates, over the benchmark full faith and credit of the United States, whether that's actually pricing in the economic pain that a 4 to 4.5% Fed funds rate is conferring. Do you think so?
So at this point, it's not. It's really pricing in a slowdown of the economy. It's not pricing in a hard recession. I think at this point, all-in yields, historically, have not been this high in 13 years. So if you're looking at pure credit spreads versus all-in yields, it's a little bit different of a story. But we're not seeing a lot of pain in corporate credit the last few weeks, or last week or so, even after the CPI. It's mainly been rate-driven. So the credit markets are telling you that corporations can get through this. That unless this inflation continues forever, at some point we're going to get the Fed more in balance, and we're actually going to see the strength of these balance sheets win out. But we still have to get to that terminal terminal high and terminal rate in order to know, how bad it's going to be from the Fed.
A number of investors have gotten pretty bullish, actually, on the prospect of credit. I'm thinking, for example, of Jeff Gundlach over at Double Line or Oaktree, seeing equity-like potential returns in credit. Do you agree that at this point it's a time to lean in and that you're going to get really good returns?
So yeah, we look at the difference between equity yields and credit yields, and I like to look at 3 to 5 year credit yields because you don't have to take on a lot of duration there, and you're getting about 3 percentage points extra yield by buying bonds than you are buying stocks. And so to me, it's a very attractive time to be buying bonds versus stocks. And I'm not not a stock expert, but I'm just saying on a relative basis, it looks pretty good to me. And so from that standpoint, you're locking in 5% yields for the first time since 2009 on 10-year credit. You can lock in pretty much the same on front-end credit. So I like credit at this point. Again, I just think that the timing is very difficult. But if you're able to close your eyes and buy, we think you're going to do well.
Matt, I've got no problem with the bond market guys talking about stocks. The stock market guys do it all the time. They're always talking about the bond market. Matt, Lisa and I have reflected on the following over the last week or so. In fact, we've been doing it for a few months now. The tone that I still get from a lot of guests on this program is that these issues are still somewhat temporary. That even if the Fed goes to 4, 4.5, ultimately we return to the world of the last 10 years or so. Are you pushing back against that, Matt?
I think we'll eventually get there, but it's just taking so long to get anywhere. If you just think about how long we've been in this pandemic, how long we've been in, we're officially out of it now, I guess, but it's just taking longer to get out of everything and to get back to normal. So I think the longer term trends down the road, aging demographics, technological innovation, those are key drivers of having deflation or lower inflation, but they just can't take place fast enough right now. And so in that regard, any expectations that we would have had for a quicker turnaround have been put on hold, or a quicker return to normal. And so from that standpoint, we're going to have to ride this out a little longer. The next CPI print is going to be on everybody's mind, but that may not be enough. We're going to have to wait for another one and then another one. So call it 2024, 2025, but it's not happening nearly as quickly as we'd like it to. We just have to rely on valuations being attractive at this point.
Just quickly, Matt, what would you be asking Fed Chair Jay Powell this Wednesday? What do you want to hear from him?
So I want to know two things. First off, what are you going to do with your mortgage book? Are you going to start to sell? Are you considering that at this point at least? And then second, I want to know how patient are you? We know that there's a lot of hikes that have been in the pipeline. There's a lot of hikes that are going to hit the economy at some point. How patient are you willing to be? And at what point are you going to be even more aggressive? That would be 100 basis points rather than 75. I think he's going to take his time. I think he has to know that this is going to slow the economy. But if he just says, I'm out of patience, that's going to be a problem.
Matt Brill of Invesco. Matt, it's good to catch up, buddy. As always, what a morning for this bond market. Yields up 7 basis points, 393 on a 2-year. We're looking at 394 right now. On a 10-year, through 350. We're talking about levels we haven't seen since 2011. Lisa, it's been a while.
Yeah, and I'm looking right now at credit, and if you take a look at investment-grade corporate bonds, the yield is the highest going back to 2009. This is the all-in yield at more than 5%. You just wonder, and it goes to your question, which is a really good one, are we going back to what we're used to in 3 years, 4 years? Or is this regime change, a move away from zero rates, a move away from the ability to keep lowering rates in response to financial pain because of the inflation that we've seen and the fact that it is harder to get rid of?
I'd suggest the consensus is still on the former and not the latter.
Correct.
I wonder what it would take for many people to capitulate on that view.
Whether there's a sense of some sort of structural inflation that's different, but how long before people realize that? I mean, people could say, like Larry Summers is saying, it's here, take a look, it's stickier, and especially the way that people have termed out certain debt creates more availability for rates to be higher generally in the economy.
We're unwinding an era of unprecedented monetary policy, literally a decade of it.
I know, more than a decade.
And we're having this conversation as if everything's going back to normal in the first half of next year. Maybe it will. I'm just saying that there are some big questions to ask here. TK got in touch Saturday night. He made it to a Tottenham game.
Oh, good.
He was almost crying on the phone. He said, "Thank you so much for introducing me to this garbage." I'm pretty sure that was a compliment.
Yeah, that's heartrending.
Okay, futures negative 0.8 on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It was the final public moment for a woman who reigned over her country for 70 years. World leaders gathered in London for the funeral of Queen Elizabeth II today. Her coffin was transported by carriage from Parliament to Westminster Abbey for the services. Over the past 4 days, hundreds of thousands waited in line for hours to pay their respects. President Biden says U.S. forces would defend Taiwan if there was what he called an unprecedented attack. It was the administration's latest pledge of support as it seeks to deter China from increasing military pressure on Taiwan. The president was interviewed for the CBS News program 60 Minutes. A recession in the euro area now looks almost inevitable to economists. Those polled by Bloomberg put the probability of 2 straight quarters of contraction at 80% in the next 12 months. That's up from 60% in a previous survey. There's growing concern that an energy squeeze this winter could cause a slump in economic activity. The EU's executive arm has recommended freezing $7.5 billion in funds earmarked for Prime Minister Viktor Orban's government in Hungary. That's because of allegations of corruption and fraud. Orban has rewritten Hungary's constitution, overhauled election rules, and even extended his influence over the courts and education. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We agree with what we signed on to a long time ago. And that there's a one China policy, and Taiwan makes their own judgments about their independence. We are not moving, we're not encouraging their being independent. That's their decision.
But would U.S. forces defend the island?
Yes, if in fact there was an unprecedented attack.
Quite an exchange in this country yesterday evening. President Joe Biden on CBS's 60 Minutes, live from New York City this morning. Good morning with Lisa Abramowicz. I'm Jonathan Ferro. Futures negative 0.9 on the S&P. On the Nasdaq 100, we're down 1.4 percentage point. Yields are higher by 7 basis points at the front end on a 2-year, 393 on a 10-year, through 350. The highest level on a 10-year going back to 2011. Crude is lower, down by almost 3 percentage points. Bramo, we're at 82.63. Talked a lot about the rate shock. I think you're right to pick up on a theme that we've got to drive home through to the end of the year. Had the rate shock, maybe. Have we had the consequences of that rate shock in this economy? I think a lot of people would push back and say no.
Right, and what you're seeing right now is people perhaps gaming that out in the oil market about a lack of demand at a time when you have arguably shortages or a lack of supply to meet certain demand in the oil market. So to see that kind of decline is quite notable.
The gas price is lower. That's been a theme for this president, helping him out. Crude's lower for the wrong reasons, I'd argue at the moment. Lisa, wouldn't you?
Well, I mean, it's lower because people expect lower growth and people not to move around and industry to shut down in the face of higher prices. Not great.
AMH joins us now. Anne-Marie, our DC correspondent, and she's here in New York City. It's good to see you, AMH. Can we just talk about those comments on Taiwan? Is that the strategic ambiguity that this president is looking for?
Clearly, this is the 4th time he's said similar comments about defending Taiwan. Remember in May, he was asked, would the U.S. defend it militarily? He said yes. Then White House aides came out and they said what they meant is we would send more hardware. But this interview was a little bit different. Not only did he say, yes, we defend Taiwan, but then when you had the interviewee following up saying, U.S. policy has not changed. Are you basically saying that U.S. forces, men and women, would defend Taiwan in the event of a Chinese invasion, unlike Ukraine? Again, a direct yes from the U.S. president. It comes at a time, though, where U.S.-China relations are really in this difficult place. Obviously, last month, we had Speaker Pelosi go to Taiwan. We saw massive provocations in terms of military drills around the Strait. China cutting off climate talks, cutting off military talks from the United States. And then in Washington, there's talk of potential new legislation that would say Taiwan is a major non-U.S. NATO ally, as well as sending more military hardware. So you have a deterioration in these two countries, and the president is now coming out and saying something that really is going to put the backs up of individuals in Beijing, especially ahead of this massive party congress for Xi Jinping.
Is there any connection between President Biden's discussions and comments now and the meeting between Vladimir Putin and Xi Jinping over the past week?
Well, potentially Biden just wants to show a big, strong force that he will defend countries like Taiwan and countries that he feels that other nations are entreating, encroaching on their sovereignty. I think what you saw between Xi Jinping and Vladimir Putin was actually Putin for the first time basically saying to China, we know we've put you in this difficult position. And maybe the president is harping on that difficult position now these two leaders find themselves in.
This was quite an interview with President Biden. He talked about a lot of things, saying that the pandemic was over. He expects inflation to eventually abate. He also talked about the potential for another run at president, basically saying he would decide after the midterm elections. Is that a shift in tone? Is that less conviction at a time when he doesn't necessarily have the popularity behind that likelihood of a 2024 run?
Yeah, and he also talked about the fact that if he was going to come out and declare this, there's a lot of legal issues that go into that, and he's not ready to make that decision, but he will at some point. Although there is lots of talk that if it was to be President Trump, then it would be President Biden for the Democrats. But we should note, the First Lady, Jill Biden, said that she hadn't had this conversation with the president when she gave an interview to the Today Show. And while we have seen the president really come under a lot of strain and pressure in the polls, I think the NBC poll that is out is pretty astonishing. 45% is now President Biden's approval rating. That is the most we've seen since October 2021. So basically, it took him an entire year to get back to this point. And what a moment to get back to this point, because we're less than 2 months away, from the midterm elections.
The direction of travel here is really important. AMH, There was a theme on this program through much of this year. We talked about the calendar potentially being on the president's side and on his party's side as well. If the midterms were back in spring, they take a beating, an absolute hammering. If the midterms were right now, just how close are things?
And John, honestly, credit where credit is due. You said that early this summer. You said, I think the calendar may be on the Democrat side. They potentially have this. Can you imagine it was midterm elections in June with gasoline prices at $5 a gallon? This would have been really difficult for them. It's very close right now. In this same NBC poll, you have they're leveling out Democrats and Republicans in terms of congressional seats, in terms of what people are focused on. When you look at all the polls, it really comes down to the issues like immigration, migration, the economy. People are more for the Republicans. But when it comes down to healthcare, when it comes down to abortion, you do see these numbers tick up. And the Wall Street Journal poll this just about a month or so ago, overall, people say they want to go out. And when they go out and vote, top of mind is the economy. But second is abortion and women's access to reproductive rights. And third is inflation. So you do see really two major big competing issues that both sides are trying to harp on. But to your point, the calendar is on their side in the sense that if this was in the summer, it would have been much more difficult.
AMH, awesome to have you here in New York City. I know the president's going to be speaking later this week as well. Anne-Marie Jourdain there, here in New York. Lisa, what a change in the last, 3 months? Just 3 months?
3 months, interesting time frame. Guess what? 97 days straight of falling gasoline prices. Go. So there's your 3 months, and it coheres pretty directly. How much is that really the driving factor at a time when that is the benchmark for so many people walking, driving down the street, seeing the prices? It's basically like an inflation read. If you take a look at the gasoline banners, what the price is, it's changed.
Pretty strong correlation between UMich consumer sentiment as well and the direction of that chart you're speaking to.
I wonder what happens if there is some change in China. And I know this sounds like, the butterfly theory or whatever.
Sure.
But if there is a change in zero COVID, if there is a shift with respect to the winter months and demand, does that change the narrative? How quickly can that happen based on how quickly people have readjusted their expectations with growth and mobility?
Pretty strong inverse correlation.
Correct.
You all understood that anyway. Futures down 0.9%.
Thank you for correcting me. I appreciate it.
It's for me because no doubt someone will say, what are you talking about? Anyway, there you go. There's your clarification.
Thank you. I appreciate that.
Like one guy out there on Twitter.
Okay.
Just know anyway.
I love that you have my back. Thank you.
The Nasdaq's down 0.9%. I was correcting me, not you.
No.
Former Vice Chair Richard Clarida later this week around the Fed decision. The Fed decides, live on Bloomberg TV and Radio on Wednesday. This is Bloomberg. You are not waking up to an equity market bounce this morning. From New York, Good morning. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Futures down 8 or 9/10% on the S&P. On the Nasdaq 100, futures down 9/10%. Yields are higher, up 4 basis points on a 10-year 349, briefly through 350 on a 2-year 393. Yields up at the front end by 6 basis points. Guess what? The dollar's stronger. Euro dollar negative 1/3% at 99.90 on euro dollar, and we're down on crude 82.71. WTI down by 2.8%. Nat gas down about 3%. What is it, Bramo? Crude's up, gas is up, and it's bad. Crude's down, gas is down, and everyone's like, it's bad. It's never good, is it?
Well, right now, no. And that seems to be the tone when it comes to the oil market and also potentially for the bond market, right? I mean, right now, yields are up, and that's bad, but yields are low, and then the Fed has to come out and actually hammer them higher in order to get the tightening of the financial conditions. Right now is a tricky position. And nobody can figure out that soft landing that Joe Biden was talking about and how likely that really is or not.
Even when the 10-year yield starts plummeting, they'll be telling you it's really bad.
It's really bad.
It's really bad. The 30 years up a couple of basis points, 354. I get the game. I get it. It's just, it's worth pointing out sometimes. Dana Peterson joins us now, chief economist at the Conference Board. Dana, can you tell us how bad things are in this economy? Because the data we're still getting signals resilience. Are you seeing the same thing?
Sure. We're definitely seeing resilience in the U.S. economy. The labor market's still strong. Jobless claims have been coming off. The JOLTS data tell us that there's still a lot of job openings. When we look at GDP tracking for the third quarter, maybe we'll have something just slightly north of zero. Certainly consumers did spend in August. Spending was up 0.2 of a percentage point in real terms. And also the trade outlook is looking a little bit better. With all of that, we think that the Fed it's a great opportunity for the Fed to continue to raise interest rates to tackle really elevated inflation.
Okay, so to go to John's point, is consumer resilience good or bad? You're saying it's a good opportunity for the Fed to raise rates, which other people would say is bad for the economy longer term.
Well, I mean, the thing is that inflation is really bad, right? So the headline inflation for the CPI only ticked down to 8.3%. Meanwhile, the core moved upward to 6.3%. A lot of the drivers are food and shelter costs, basics for consumers. So that's really negative for the consumer, and certainly it erodes their incomes. And so it's definitely not a good thing if you have high inflation, but certainly it is a good thing if consumers are able to still weather higher interest rate hikes. Certainly that weighs on housing purchases, but nonetheless, it's still a good thing overall for the economy.
Do you have a sense of how quickly we're going to see the effects of the rate rises that we've already seen, of quantitative tightening that has yet to really happen, but ostensibly will happen at some point in the near future? How long does it take before it hits the economy?
Well, I mean, the thing is that it's really difficult to know. I mean, back a long time ago, we would say, well, it takes 12 to 18 months for any Fed actions to really feed through. But we're already seeing that Fed actions are having an impact on the housing market. And that's certainly a positive for the Fed in terms of its addressing inflation. So you're getting at those asset prices, even though the Fed does not target asset prices. But certainly in terms of the consumer price indexes, the Fed still, really needs to do the work now, and we should probably start seeing the effects later on next year. We're thinking that key inflation gauges probably won't return to 2% until very early 2024.
Dana, every single piece of research we've had basically over the last week has been a bank somewhere on Wall Street upgrading their terminal rate view. Goldman, the latest, they look for 4 to 4.25 by year-end in 22, and maybe higher than that by the time we get through 2023. Dana, the number one pushback that Lisa gets, that I get, that Tom gets, is that we can't live with 4% rates, that this economy just can't live with it, that the debt piles is too high, the sovereign and the treasury. Dana, do you agree with that? What's the constructive view on why we can live with a 4.5% Fed funds rate?
Well, I mean, first of all, I want to say the Conference Board came out really early with that call for interest rate topping out at 4%. And we've even been saying it could be even higher if inflation doesn't really move and it remains sticky. But I think the U.S. economy can. And certainly when you think about what policymakers have been saying, they're saying, look, we're in for a bit of pain, which I think is code for a recession, a mild, maybe brief recession. And certainly when you look at the labor markets, that's still super strong. It's going to remain pretty robust, especially given the fact that you have labor shortages. And so that means there's still going to be some hiring and not a cratering in the labor market. I think with all of that, yes, the U.S. economy is going to have to endure a period of elevated interest rates in order to tackle inflation. Inflation's the worst problem here.
So, Dana, that's going to lead to higher unemployment by design. And we've been talking about this. How much higher? I mean, do we see a commensurate increase in your expectations for the unemployment rate with every increase that we hear, to John's point from Wall Street, about the Fed funds rate and where we end up?
We think with our forecast of a 4% Fed funds rate, we think the unemployment rate will probably rise to 4%. Even still, that's incredibly low. And even if we go to 4.5%, that's probably around the neutral rate. And so that suggests we still have a very strong labor market. We're not expecting to see 5 and 6% unemployment here. This is a very different labor market. We didn't have shortages 10, 20 years ago. We do now, and that's really going to help, I think, keep the labor market from worsening relative to the overall economy.
Is it instructive for us to look at averages here when we talk about the labor market, when we talk about how well different households can weather this, especially because you're talking about, half of the income in the United States driven by households that earn more than $100,000 is put out there by Morgan Stanley. Most of them own their own homes, either outright or else with mortgage rates that were locked in low, at very low rates. The rest of the economy, the rest of the households are really struggling, both because they've got lower income and because they have not fixed costs, but pay rents and have to deal with the increase there. How do you gauge that out at a time where we're looking at averages to determine policy?
Well, it's interesting when you look at certainly wage gains, the folks who've gained the most in terms of wage gains over the last couple of years have been people on the lower end of the income spectrum, also people who've been quitting, also people who work in those in-person services types of jobs that tend to have lower wages in general. Those are the people who have seen the biggest gains in wages. And so we certainly should look at the granular data, but it's not necessarily the case that folks at the lower end of the spectrum have been losing out here. They've actually been gaining by quitting and also through the very aggressive tactics that companies have been using to attract labor, especially for businesses like restaurants and hotels and manufacturing and transportation, which tend to have folks on the lower end of the income spectrum.
Lisa, credit to Jean Bavin of BlackRock for coming out in the last month or so and raising a question that I don't think we've talked enough about, which is what is the appropriate time frame to try and bring inflation back towards target? What you hear there from Dana is 2024, not a 2023 story. And I just wonder if the risk is skewed towards maybe pushing that out even further. This task might be bigger, more difficult than maybe we've given it credit for.
And perhaps people won't have the appetite for some of the economic pain in order to get it down to 2% by 2023 or even 2024. And I think that, to your point, is the whole Adam Posen view. Do we get comfortable with a 3% target for a little bit longer? Is that politically feasible?
Dana, would you go with that? Do you think maybe risks are skewed to this taking longer?
Well, it certainly is in our forecast that it's going to take a while. We don't have the we don't have interest rates. We don't have interest rates falling next year because we think inflation is going to remain elevated. And certainly this is going to take some time, but there is that possibility out there. This is something that I was saying earlier in the spring, that maybe the Fed will get more comfortable with having inflation closer to 3% than 2%, especially if we have a very significant downturn in economic activity. But I think it's also a function of the fact that we have a lot more inflationary pressures, long-term inflationary pressures, such as labor shortages, such as the semiconductor shortage, such as industrial policies where businesses have to reorient their supply chains. It's very expensive. And so all those things are going to get passed on to the customer. And so it's going to be very difficult, I think, for the Fed to keep to keep inflation close to that 2% target. Yep. And so I think that those are all forces out there that are going to weigh on the Fed and certainly the economy over the longer term.
Dana, you're one of the best. Thanks for being with us. Dana Peterson there at the conference board. This is something Adam Posen was talking to us about over in Jackson Hole, Wyoming, Lisa of the Peterson Institute. The prospect that perhaps when it gets down to 3, the conversation starts to change.
Which is your point from earlier about have we seen peak yields on the 10-year Treasury, considering that people right now are expecting us to get back to 2% inflation rates, perhaps in 2024. What happens if they don't? What happens if they signal that they'll go a little less aggressively and wait to see what the ramifications are and then adjust as needed because they are worried about the potential consequence to the economy? What then does that say about the 10-year?
This is tremendously difficult to game out. Basically, you're questioning their credibility and whether you truly believe that they are conditioned by the experience of the 1970s, which was the whole point of the speech from Chairman Powell in Jackson Hole, which was the risk of prematurely easing policy. If you get to 3 and start to signal that you're comfortable with that, Lisa, what happens to the outlook from there for inflation?
I just keep thinking about that one comment on Twitter about, you know,
Which
him
one?
coming out with a hawk on his shoulder and a
Just
hawk
read
tattoo.
the speech again.
And just screeching like a hawk and trying to get that communication through. That's what they're messaging now. What happens if they change that? You're right. How do they then go back? I have to give them not credit because you're going to kind of freak out at me a little bit, but I'm going to just say.
If you want to give credit to the Fed, go ahead.
Okay. It's a very difficult circumstance to understand what's going on in this economy. The data is moving very quickly, and people have not been able to predict it out. We don't have a sense of how resilient the economy will be, how interest rate sensitive it will be. Dana talking about just that. It's very difficult to really game out any forecasts in this soup of uncertainty.
That was a real special moment on this program, just to listen to you being sympathetic towards the Federal Reserve.
Thanks, I appreciate it.
For the grand total of 30 seconds.
Special.
Victoria
Special.
Green.
I aspire to being called special by you.
G-Squared Private Wealth is going to join us going into the open with Michael Kushner of Morgan Stanley Investment Management and Dan Ives of Wedbush Securities. We'll catch up with all three of them around the opening bell. Futures down 0.75%. Lisa, good to be with you in a studio here in New York.
Yeah.
TK not too far behind. He's going to be with us in a couple of days for the Fed decision. We hope.
We're here.
Maybe, perhaps. We'll
see
him again.
Depends what the Tots are playing.
Yes, or perhaps he's going to move permanently to London, which is something he suggested to me and you last week.
Many times.
Many times. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Leaders from around the world gathered in London today for the funeral of Queen Elizabeth II. More than 2,000 people attended the ceremony in Westminster Abbey for the UK's longest-serving monarch. Over the last 4 days, hundreds of thousands of people lined up for hours to pay their final respects. President Biden says he warned China's Xi Jinping it would be a huge mistake to violate sanctions imposed on Russia. Still, the president says there's been no indication that Beijing has provided weapons to Russia for its war in Ukraine. Biden was interviewed for the CBS News program 60 Minutes. Ukraine's President Volodymyr Zelensky has renewed his pledge to retake all Russian-controlled territory after his country's recent advances. Zelensky hinted that another offensive is being planned. Ukraine claims that some Russian military units suffered loss rates of up to 90% in their retreat. In Hong Kong, local media report the city may end hotel quarantine and pre-flight COVID test requirements for incoming travelers. That would be its most significant moves yet to end more than 2 years of global isolation. The changes may come before a series of major international events set for Hong Kong starting in late October. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
They are feeling their way to how far they have to raise the federal funds rate. They want to be restrictive. They want aggregate demand to slow down a lot so that that underlying inflationary pressure starts to ebb. But what they don't want to do is intentionally cause a recession. And getting to that point, I think, will require a bit of luck.
That was Seth Carpenter, global chief economist at Morgan Stanley, speaking with us last week. And this has really been one of the main issues for so many market participants. To get to a soft landing, it takes a narrower and narrower confluence of potential outcomes. Peter Scheer has been tracking this closely as today we talk about the potential for peak hawkishness, or this is complete repricing of market expectations for the Federal Reserve. Peter Scheer, head of macro strategy at Academy Securities, joining us now. And Peter, you were talking about last week and that something happened that was pretty dramatic in your view, and it wasn't necessarily a total reset of Fed expectations. It was FedEx. Explain.
Listen, I keep looking at the data, and a lot of the data we get is backward looking. It's weak. It tends to get revised. So I'm kind of looking, what is really contemporaneous? What is effective? And the FedEx warning to me is real, right? That's someone seeing business move in real time. It's data today. It came right on the heels of CPI, where we had housing inflation was up 0.7%, one of the biggest contributors to the CPI. And yet, as far as anyone can tell, nothing good is going on in the housing market right now. So I think we all know where the data is headed as the official data catches up. And it's going to be weak, and it's going to be a little bit scary.
So do you think that the Fed's going to reflect this on Wednesday when we hear from them?
Wow, I think they are caught in such a, between a rock and a hard spot where they've been so hawkish starting at Jackson Hole. They've been continuing that message. But I think someone's got to step back and say, okay, we've got to be a little bit careful. Traditionally, it does take some time for our hikes to come through the economy. And everything we're seeing real time, and especially if you look at the wealth effect, is saying, whoa, this is getting a little bit dangerous. I think the fixation on CPI, how it's calculated, is wrong. I think Powell, as usual, is going to wind up having to let some of his inner dove come out.
So you said it's getting a little bit dangerous. Can you explain? Because a lot of people are pointing to the resilience of the consumer. Yes, perhaps FedEx is an outlier. Perhaps there's some idiosyncratic issues in tandem with a global economy that's slowing down. But what are you looking at that's telling you that things are getting dangerous?
Well, I'll even go back to the consumer, right? People are saying the consumer did well. But if you look at the control group, people thought they spent 0.8% last month. It turns out they only spent 0.4. Expectations were 0.5 this month. They spent 0%. So I don't think the consumer is anywhere near as strong. I think they're going back to buying discounting. I'm watching the inventory build, which has been shocking. We're seeing month after month after month of inventory build as two things I think happen. One, companies overestimated consumer demand. They didn't realize how much consumers were pulling forward because they were worried about supply chains. And two, companies were so worried about supply chains, they've overstocked. So I think that's a real hangover for this economy. Then I look at crypto and that whole market space, right? It went to $2 trillion. It funded all these industries. They're all struggling. And they were spending money wherever they could, right? They were buying chips. They were buying new computer systems. They were buying, ads on anything. As they have to focus on actually just survival and turning cash flow positive, that's going to be a big chunk of this economy. These disruptive stocks, I keep coming back to them. They were such a huge part of the growth story. And I think they're going to really weigh on the economy because their employees were rich in spending and the companies themselves were cash rich in spending. And that's not occurring right now.
Okay, so Peter, you said that Fed Chair Jay Powell needs to let out his inner dove in order to counteract some of the weakness that you're seeing to build at a pretty rapid clip throughout the economy. But then other people, particularly equity bulls, would argue this is exactly what they're counting on. Basically, the Fed pivoting, right? This goes back to that discussion that exhausted so many people, and nobody wanted to hear the P word ever again. I mean, is that basically what you're saying, that this is a bull case for markets because it is a bear case for the economy and a bear case for this Federal Reserve?
I think it's a temporary bull case. I think we're well past the stage of lower yields being good for the economy. I think we might get a bounce on the Fed if he does this little bit of a pivot. But I think the reality is just he's gone too far. We're still starting to feel the impacts of what's gone on before. And people are going to realize generally lower commodity prices, lower bond yields are the risk off type trade. I think we forgot all about that. And then let's not forget, we've started quantitative tightening a little bit more aggressively. We're going to see more of that. And to me, I've always believed that quantitative easing really forced people out the risk spectrum and inflated all asset prices. And so I think the corollary of that is going to be that quantitative tightening allows people to move down the risk spectrum. So I think you've got that as an additional headwind, and that's just starting to ramp up.
So right now I'm looking at two-year yields that have really pushed higher dramatically this morning, 3.93%. We're really close to that 4% level. If you talk about lower yields being a bad thing for the economy, is it a good thing as an investor to go into bonds as an actual haven at a time when they're providing yield? We were hearing from David Stubbs from JP Morgan. We've heard from Matt Brill over at Invesco, both talking up the bull case for bonds.
Yeah, I would agree with that. I'm definitely overweight bonds. I like them. I hate to even say this because it's been such a disaster, but the 20-year Treasury actually is appealing. And over the past 3 weeks, I think we've seen a little bit more support for that 20-year. It's just such an outlier in the yield curve that it seems attractive. So I like being overweight bonds. I like the longer dated more than the front end just because I think we'll get more bang for the buck. But I think that's it's going to be important. And I don't think stocks are going to go higher on the back of lower yields, maybe initially, but it's going to be one of these risk-off type trades.
So we've heard from Oaktree, we've heard from Double Line, Jeff Gundlach, and they've been talking about pretty extreme yield returns for credit, for some of this longer-term debt, talking up equity-like returns. Is that plausible in your view, or do you think that this is going to just be less painful for bond investors than for stocks?
Yeah, I think it's just going to be less painful. I think quantitative tightening is going to keep a lid on the ability for bonds to really, really rally. And I think it's going to take a little bit of time for the economic data to sink in. So I think you'll get a decent gain. I could see a 10% return on the long bond over the next month or two.
Over the next month or two. So,
yeah.
Wow. What are you looking to hear from Fed Chair Jay Powell on Wednesday?
What I'd like to hear is him paying a little bit more attention to the econ data, to the forward-looking stuff, maybe even, a shout out to the FedEx and say, hey, we have to manage both sides of this, right? We do have full employment as well as inflation. There's a lot of signs inflation are rolling over. We've got to look at the more contemporaneous data. I think something like that would be realistic. I think if he starts pounding on that 75 bits for the next meeting, blah, 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 I think markets are going to respond very, very poorly because he's just going to drive us into a recession.
Just real quick here, I'm wondering your perspective on oil prices. We were talking earlier. What signal is nearly $80 on WTI sending to global markets that are still looking with this disproportionate imbalance with supply and demand?
So to me, I think it's a negative signal. And I've been talking about this going back for months. We've all been kind of looking, lower oil prices, lower inflation, that's good. Historically, whether you go back to the 2000s, the great financial crisis, European debt crisis, lower oil prices is generally bad for equities, right? It is a signal that the economy is slowing. And if you just go back to my one big argument about we underestimate how important crypto was, right? If they were generating through their mining all this energy usage and that industry starts dying off, which I think it's very high probability that it does in the coming months, that's just another source of demand that we had. So I think, again, we're spending way too much policy time responding to prior problems than to the current problems.
Peter Scheer of Academy Securities, thank you so much for being with us on a day when people really are trying to figure out the meaning behind a near 4% two-year yield. Shocking to get my head around that, considering some of the low rates that we've been accustomed to. Coming up in Balance of Power on Bloomberg TV and Radio, Betsy Stevenson, Bloomberg opinion columnist and really respected economist, will be speaking. Right now, we are looking at yields higher across the board, 350, the highest level in the 10-year yield going back to 2011 as people reset their expectations ahead of Wednesday's Fed meeting. This is Bloomberg.